Hi folks, welcome to Retiring Well. We got a great show lined up for you today. We're going to be talking about those 3 success questions you want to answer when it comes to an income plan. How about active versus passive management? Have you ever wondered what the difference is? Roth IRAs, what are the intricacies of that, and when is it a good thing or bad thing to be in it? And then finally, going to end with an old episode that Mike Reese did on who owns your IRA. So folks, stay tuned. It's going to be a great show.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
3 retirement success questions you must be able to answer. First of all, you have to know how much income you need or want in retirement. Now folks, a lot of people will start with what they're making as they're working, right? Wouldn't it be nice if you could enter into retirement making as much as you were when you were working? That would be ideal, right? And that would be a great place to start. But what if we have to kind of put the pencil to the paper, as they say, and kind of nail that number down a little bit? That would be highly recommended, because if we're going to do an income plan, we have to know what income we're planning for. So the first question we have to ask is, how much income do we want or need? Let's start with that number. The second question we want to ask is, how much income can I count on that's guaranteed? All right, there's only a few sources of what we would call guaranteed income. There's Social Security, it's backed by the U.S. government, so hopefully that's going to be good. You've got pensions. Okay, they're going to be guaranteed by either a government or some company. Now, hopefully it's a company that's got good credit quality that's going to be around for a while, because maybe it won't be guaranteed, right? But these are sources of income that we can hopefully count on. Another one might be an annuity, like a TIAA-CREF or something that's spitting out a guaranteed income. But this is, if we answered the first question, how much income do we want or need, and then we can answer the second question, how much income can I count on to be guaranteed to be consistently coming in, the last question we have to answer is, where am I going to make up the difference? Let's say I want or need this number, I know I can count on this, but what's that? Where's that going to come from? Folks, that's going to have to come from your retirement savings. These are all those accounts that you've been hopefully putting money into to save for retirement. Those IRAs, the 401ks, the 403bs, the 457s. And by the way, all those numbers, all they are is IRS tax codes, okay, showing those sections. So if I know what I want or need, I know what I can count on, and I'm going to try to make up that difference, how do I know how much that difference needs to be? All right. As a general rule, when we're pulling from retirement accounts, we like to use what we call the 4 or 5% rule, meaning that's how much of our savings we can pull and count on for income. Now, it's not brain surgery, because if we can get an account to grow by 4, 5, 6% while we're pulling out 4 or 5%, then that's going to work all day long. But most important, as you can tell, I'm going to have to be sure that that's a consistent income that I can take. So folks, those 3 questions have to be answered. And then once we answer them, putting that together in a plan that also accounts for inflation is going to be very important. So if you're somebody that wants that kind of planning, want an income plan, want to know if you have enough for retirement, then please give us a call.
Professional golfers have a game plan. Knowing where to attack the golf course is vital, and avoiding the hazards is key. As you can see, we aren't professional golfers. But at Northern Michigan's Centennial Wealth Advisory, we are professional financial advisors. And just like a good golfer, we have a game plan, a holistic approach for your financial future, using income planning, tax planning, estate planning, wealth management, and healthcare planning to help you plan to retire well. We have lived in Northern Michigan all our lives, and we have offices in Traverse City, Gaylord, Petoskey, and Cadillac. Give Centennial Wealth Advisory a call or visit us at cen-wealth.com and let us help you plan to retire well.
If you are retired or soon to be retired, let us help you plan to retire well. Centennial Wealth Advisory specializes in retirement planning and has offices in Traverse City, Cadillac, Petoskey, and Gaylord. We'll never pressure anyone to become a client. Our goal is to inform and educate. Simply attend one of our live events or schedule a meeting at one of our Northern Michigan office locations for a free, no obligation retirement review.
Hi, welcome back. Listen, in this segment, I want to talk to you about what is called passive investing versus what we call active management. Two different things, folks, and it's something you're going to want to be very, very aware of. First of all, one thing that's out there that's it's growing in popularity is what we call ETFs, or exchange traded funds. Okay, like these, like a bucket of securities. All right, and basically once you put all those securities in that bucket closes. Okay, there's no longer any trading happening on it. It's basically like an index. You're just basically tracking that bucket of securities. That's what an exchange traded fund is. Now, they trade on the New York Stock Exchange just like a stock does. They're highly liquid because you can buy and sell them right on the exchange. But basically it's passive because there's no trading anymore going on with that account. That bucket, that ETF is going to hold those securities no matter what until you sell it. Okay, so you might find if there's no changes happening, then that's probably leaning more towards, you know, a passive account. The other thing is when you look at a mutual fund, for example, all mutual funds have objectives, okay? Meaning they have an objective to hold certain securities in that fund, in that account. Okay, now unlike an ETF or an exchange traded fund, there's trading going on within that account, okay, based on that objective in the securities they hold. For example, let's say I'm in what I call a large cap mutual fund. That's simply a mutual fund that has to hold large company stocks. That's what its objective is to do. And so that fund manager is going to buy and sell large company stocks within that portfolio. Now, even though that change is happening, you've got, you know, some management happening with that. It's somewhat passive in the sense that it's only going to hold those securities that it holds. All right. Now, the key factor to understand when you're dealing with ETFs or mutual funds is understanding what they hold and what they're going to do when market conditions change. Because if all you're holding is certain sectors or certain asset classes and you don't have effective diversification, then it's going to be very passive because it's not going to change up a whole lot. Okay? Now, active management, these are going to be fund managers or portfolios that are actually going to change with the market conditions. They might not be held to objectively hold any particular assets within their portfolio. If they see interest rates rising and bond values maybe going down, then guess what? They can change that up. Maybe they can lower their exposure accordingly. All right? But what you want, when market conditions get such that, especially as we approach recessionary times, you're going to want to be careful what kind of account you're in, because you may find it necessary to maybe be more in accounts that are active that can change up rather than be passive. So if this is a concern for you, something that you want to understand more about, then I encourage you, give us a call because we'll gladly take a look at that for you.
So true as far as those different success questions that Larry talked about there, and as well as that active and passive management. And when I think of the different success questions, it comes back so heavily in retirement of structuring a portfolio that can generate an income stream for you. And I know, Nick, that's something in the Gaylord and Petoskey offices, you're talking to folks constantly about that, and just there's a lot to take in with it.
Yeah, there's so many different variables when it comes to income planning. And one of the neat things that we have as a tool, one of our tools is our Retirement Analyzer program. It really paints that picture, gives you that 10,000-foot view on where you're getting all your income from. But I think one of the main concerns that a lot of people are realizing right now is, what does inflation look like? And really, I had a client describe it best recently. He said, you've got your go-go years, your slow-go years, and your no-go years. So those first 10 years or so in retirement, you're going out to eat more, you're spending more money. Whereas 75, 80 years old, you're not going out as much. And then after 80, 85 years old, you're not really spending as much. So Yes, inflation is a concern, obviously, but we also got to take into account you're not going to be spending as much money 20 years down the road either.
Yeah, so true, and that's something that we see day in and day out as we're trying to map out that plan. And it's important for you to take a look at, like Nick had mentioned, that 10,000 foot view to see how long is your money going to last, because that seems to be a key question that people are wondering about. And along with that fits in this active versus passive management, and how volatility in the markets can really impact your retirement plan. And so when you're looking at your portfolio, it's good to understand sort of how much of the portfolio is going to be structured maybe more passively, where it's going to ride up and down with the markets, and how much of it is maybe going to be more actively managed or adjusted when markets are fluctuating. So if you're in a situation where you haven't taken a look at that 10,000 foot view, or not quite sure what percentage of the portfolio is active versus passively managed, we'd love the opportunity to sit down with you and talk about that more. Stay tuned as we're going to be talking about Roth IRAs next.
Are you nearing retirement or in retirement? Have you had your portfolio just looked at, or have a second opinion on that portfolio recently? Centennial Wealth is a full service advisory firm, and we have multiple locations in northern Michigan. I'm in the Gaylord office primarily. The office is right downtown Gaylord. Also up in the Petoskey office as well. That office is right off of 31. I'd love to hear your story. I'd love to sit down and chat, and it's a free, no obligation consultation, so just call the number on the screen.
Hi, listen, in this segment, I want to talk about Roth IRAs and some of the particulars thereof. First of all, you know, with the Roth IRA you put in with after-tax dollars, it grows tax deferred, and then one day when you pull it out, it's tax-free, okay? Now there's contribution limits every year and how much you can put into a Roth IRA. I think for 2021, it's $6,000. If you're older than age 50, you can make it $7,000. And you can split that between a Roth IRA or an IRA. Okay, important to understand though, if you're going to contribute to a Roth IRA, you do still have to have earned income to match it. Okay, now conversions, this is an amount by which you can take an IRA and convert it over to a Roth IRA. No contribution limits there. It can be an unlimited amount, and there's no earnings restrictions. Okay, so you can have no income, take $1 million IRA and convert it completely over to a Roth IRA if that makes sense. So important to understand that your original contribution into a Roth IRA is never going to be taxable. Okay, you can put it in and take it out at any time. When you pull money out of a Roth IRA, it's those contributions that are going to come out first. Okay, what gets confusing is the earnings on that Roth IRA. There's some special rules that apply. Now, if I can get to age 59 and a half and I've had my Roth IRA for 5 years or longer, I can meet both those marks, my earnings are not going to be taxable. Okay, but if I don't meet those two criteria, there's different things that apply here, which I'm going to just show you. So here's a situation where a person has not reached the age of 59 and a half. They've not reached the 5-year mark, neither one. Well, now that earnings, remember the earnings, are going to be taxable, and they're going to be subject to a 10% penalty. Okay, now what if you have a situation where I have reached the age of 59 and a half, but I've not met the 5-year rule? Okay, now your Roth IRA is going to be, that earnings again are going to be taxable, but there's no 10% penalty. Okay, well, how about a situation where I've not met the 59 and a half, but I have now at least met the 5-year rule? Okay, well, in this particular case, the earnings are going to be taxable, and they're going to be subject to the 10% penalty. Now, there's exceptions to some of these penalties or the tax situation depending on the scenario. I can tell you that in this scenario where you haven't reached age 59 and a half or 5 year, there are exceptions to that penalty, okay? If you're that situation down here where you have not reached 59.5 but have the 5 years, there's going to be exception to the tax and the penalty there that are going to apply. And those exceptions are very important to understand. So folks, if you're somebody that has a Roth IRA out there and you want to know, how these maybe penalties or whether it's taxable applies to you, give us a call. It's all part of tax planning, very important.
One thing you may have noticed on the Retiring Well television show is we love talking about Roth IRAs. We see tax planning as a vital piece of your overall retirement plan. It doesn't just come down to what your investments are and what the income planning that you have, but looking specifically at what's your tax liability and what are some of those assets that maybe you've built, such as an IRA, 401k, that haven't been taxed yet. And so that's where we'd like to talk about Roth IRAs. And I know Nick and Gaylord and Petoskey, where you're constantly talking to folks about Roth IRA and tax planning.
Oh yeah, for sure. And just recently, I know there's a lot of concern with rising taxes. And I had a client join on just recently who's age 76 years old. And the big thing for him was, well, I think I'm too old for Roth account, and he doesn't have one. I was like, well, no, you're not. That's great. We can set you up with a Roth account, and we can do IRA conversions to help minimize taxes now. So you're paying your taxes now, and then assuming tax rates go up, you're going to save money, right? So, it was a great situation for that older gentleman that didn't realize that he could still have a Roth account at his advanced age.
Yeah, and we've heard that before as well from other clients where, well, maybe I'm too old to be looking at that. I had the opposite conversation with a younger client that had a brief moment in time here maybe where they had severed employment from their previous employer, and so they had a time where their income was a little bit lower for the tax year, and so we were talking about, hey, maybe it makes sense to transition some of those assets from taxable IRA accounts over to a Roth IRA. And in that process, yeah, there may be some tax implications, but that's where it's a matter of looking at what tax bracket you fall in, and maybe you're able to do that at, say, a 12% tax rate versus whatever it may look like going down the road. So if you're in a situation where you haven't looked at your tax planning and determining sort of what impact these IRAs are going to have on your portfolio over the long run, we'd strongly encourage you to give us a call, and we'd love the opportunity to just sit down and have a no cost, no obligation conversation to see if tax planning is vital for you. So stay tuned as we're going to be getting deeper into who owns your IRA.
When does a Roth IRA conversion strategy make sense? Check out our free instant download of the Wealth Report at sen-wealth.com regarding Roth IRA conversions to help you plan to retire well. Find out what the Roth IRA conversion rules are and what scenarios are beneficial from a tax perspective. To receive this instant download, simply visit sen-wealth.com, scroll down, and click Download Now to receive your copy of the Wealth Report. Simply visit sen-wealth.com.
At Centennial Wealth Advisory, we specialize in retirement planning. Folks, we put a show together every week that we talk about a number of financial topics that are critical in your retirement planning, from tax planning, estate planning, income planning, long-term care, health care planning, and investment management. If you missed the show, then you just visit our website, go to the media tab, and you'll see the latest show.
This week on CFP Talk, we are asking the question, who owns your IRA? I think that's a great question, and I think you'll agree with me before we're done here. But before we do that, I want to share just some thinking with you. So let's start over here. Now, by the way, these are circles. I know they don't look like perfect circles, but hey, I'm a financial guy. I'm not an artist, as you can tell. But think about this. Imagine, for the sake of discussion, that you own a business that's worth $500,000, right? So you own a business, and this is you. You own a business. You are a 70% owner. And SP, whoops, let's get that a little bit better. SP, this is your silent partner, right? Your silent partner. Now, your silent partner doesn't do a darn thing. You're the one that puts the money in. You're the one that does all the work. You do everything. They do absolutely nothing. But they have contributed some cash, so they're 30% partners, right? Makes sense, right? Now, same business. Because of your efforts, remember the silent partner does what? That's right, nothing at all. In fact, sometimes a silent partner does what my wife says I do at the house sometimes. I don't know what she's talking about, of course. But yeah, your silent partner, they do nothing, absolutely nothing. And here's what happens. Because of your work, your efforts, your business acumen, you build that business from a $500,000 business to a $2 million business. You increase the value of that business 4 times. Good for you. Yet, now that the business is worth $2 million, your ownership share goes, you did everything, your ownership share goes from 70 down to 60. This is you, right here, you, and this is your silent partner. Your silent partner did absolutely nothing, and their percentage goes up. Is that fair? Is that okay? Is that, do you look, that's fine, I'm cool with it. If that were your business, this is your business, this is your business. If this was your business, would you spend all the time and energy to build it up to a $2 million business only to see your ownership share go down? Or would you first, here's a better question, wouldn't you first, if you knew this was going to happen, wouldn't you say, you know what? My silent partner there owns 30%. Maybe I should buy them out before this happens. Maybe I should buy them out at 30 before their share grows to 40 and they're not doing anything. Maybe it would be a good time to buy them out. Wouldn't you think? And especially if you had, and here's what makes this cool. In this example, you are the one that gets to determine when you're going to buy out your silent partner. You can buy them out here or you can buy them out here. You're going to have to buy them out at some point. You can buy them out here or you can buy them out here when it's 40. Do you want to buy them out when they own 30 or when they own 40? Yeah, that's a big duh, isn't it? You buy them out here. Here's the other thing. You don't even have to pay them all at once. You could pay them out over time. Are you going to buy them out? Of course you're going to buy them out. Only a big dummy would let it go to this point. They didn't earn the extra percent, so don't let them. Buy them out when it's cheap, right? You buy them out when it's cheap. Everyone would do that if this were a business relationship, wouldn't they? Okay, now that you get that, here's the other thing you need to understand. I just happened to describe your IRA. That's your IRA. That's your 401k or your 403b. This is your retirement account. Because think about it. When it's small, and the silent partner is none other than the IRS. They are silent partners in your IRA. You have a $500,000 IRA at Fidelity. It's not all your money. You can't cash it out and go buy a $500,000 house. You cash it out, you only got about $350 left over because the IRS owns 30% of it. And the bigger your IRA gets, the bigger the share that the IRS owns. The bigger the share that your silent partner owns. But guess what? You can buy them out. It's called a Roth conversion. You can do it all at once. You can do it over time. But here's the deal. How many of your financial advisors are talking to you about doing Roth conversions, about buying out your silent partner so that you save tons of money over time? Are you having that conversation with your advisor, with your accountant? Probably not. They probably said, no, you're too old, right? you make too much money. You know, a bunch of that is hooey. The reality is it's a business. Treat it like a business and you make better decisions. Now, if you have questions about this or anything else we talk about on the show, please give us a call, come visit, or visit our website.
It's fun seeing Mike there from 4 years ago when he filmed that originally, and it's so true of what he's talking about still pertains to what we're looking at here in today's world, and how important taxes can be on your retirement plan. So when you're looking at your 401k or IRA, let's say, and you're seeing that, oh, I've got $100,000 saved or $500,000 or whatever the figure is, and you have to consider, okay, how much of that is really your money when you consider down the road and you're going to start taking withdrawals from that. And I know, Nick, there's different tax planning ideas associated with that, and you have a case right now that you're working through with life insurance. So talk about that.
There was a recent case that I'm working on where the client, he's got a couple different annuity products that he's taking income from, and he doesn't really need the income from it. Now they're IRA accounts, so they are taxable, but he wanted to leave a legacy for his heirs and didn't really feel comfortable investing into like a Roth account, but life insurance actually made the most sense for him. So what we were able to do was set up a lifetime payment from that annuity going to fund the life insurance policy, which is tax-free money for his beneficiaries, and it just worked out perfectly for their scenario.
Yeah, and that's it. I think of sort of a visual of you have different buckets of money, and so you may have your taxable accounts, such as the IRAs, 401ks. You may have after-tax accounts, so that might be your savings, your different brokerage types of accounts that are held after tax, and then you'd have these tax-free assets, which might include Roth IRAs. But then that's where that life insurance ultimately comes in, is almost like a tax-free squared, because not only is it tax-free to your beneficiaries, but from an estate tax planning perspective, also tax-free. So life insurance can be a valuable planning tool, again, when used properly. So you want to make sure that that you're looking at all those different details and looking at the ins and outs of what can happen with that. And so, again, if you're in a situation where you're looking at your overall retirement plan and you haven't had the opportunity to talk with somebody that is educated on what the tax implications would be, and that's something where a lot of times financial advisors may or may not be working closely with accountants, and so something here at Centennial Wealth Advisory, we have a team that supports you in that, and so we'd love that chance to just talk with you about your overall retirement plan and better understand the tax implications of what you're holding and what that looks like over the long run. So again, we offer that no cost, no obligation opportunity to sit down with you. We'd love that, and thanks again for tuning in to Retiring Well.